Index funds are for losers. I'm a loser, and if you invest in index funds, you're a loser too. But maybe that's alright. Today, I just want to have a little chat about one of the downsides of investing in index funds and ETFs, particularly low-cost passive funds. And it all centers around the fact that we have to accept that we will be losers. Some people will beat you. Sometimes. So we'll explore what it really means to be a loser in investing, and more importantly, how to deal with being a big fat loser. We're going to look at some examples and then dive into some data, explaining why it's okay to not be the best investor in the world. Let's get it. Passive index funds, or ETFs, allow us to invest in thousands of stocks from countries all around the world, for a low cost. You can use them to build up a diversified portfolio, which has the benefits of investing in different geographical regions and across different market sectors. This is great because you're spreading out the risk that you're taking on. If one particular area or region doesn't perform well, then you're not going to feel the effect so much, as it'll be such a small part of your portfolio. But there are two sides to every story, and equally, if a certain area or market sector performs well, then you're also not going to feel it that much because it's a small part of your portfolio. But who is going to feel the positive effects of it? Well, of course, that one guy who went all in on that stock or fund. This leads us right onto the main problem with low-cost index fund investing. What happens when that particular guy's portfolio triples in value over the next 3 months? Well, he tells all his friends about it, and then he puts it on social media. If you're lucky enough to know that guy, or somehow come across his fortune, then you have to listen to it. Bow down to Dave, who went all in on Bitcoin and now he's the greatest investor in the world. Makes a good story, doesn't it? So, what happens when we listen to it? Well, we naturally start to feel a bit left out. We start to think, what if? What if I went all in on Bitcoin? What if I didn't follow my own strategy? What if I just listened to my gut sometimes? No! Do not fall into this trap. It's a warning. This is exactly what I mean when I say that index funds are for losers. It's true. On any given day, at any given time, in any bear market or any bull market, there will be some investor out there who has done better than you. Somebody will have invested in some combination of stocks or some combination of cryptocurrency and had great returns. Better than yours. And of course, it's hard to listen to. Nobody wants to feel inferior to others. It's human nature. When we see other people having huge successes, we want to abandon our strategies and follow the crowd. We want a piece of the pie. But this is when we need to put our investing heads on and just take a step back and think about it for a minute. As I said before, there are two sides to every story. Every time that you get beat by this combination of stocks or cryptocurrency, there's someone out there who's losing. Their combination of stocks or crypto didn't go well. It didn't go to plan. And they're losing out. But of course, you don't hear that, because why the hell would they shout about it? Nobody wants to talk about big losses. They only want to talk about the big gains and the big cojones between the legs. So let's look at a certain example. Now, I hate to have to pick on a certain fund, but I mean, who am I kidding? I absolutely love this. So first of all, we're going to look at the ARK Innovation ETF. During 2020, ARK's Innovation ETF experienced some wild growth. 120% to be exact. Of course, that's amazing, and fair play to them. But what followed those huge returns? Of course, it's the hype. Everybody talking about the fund. It's the future. Why would you invest in anything else? Cathie Wood is a genius. Now, I'm really not trying to hate on Cathie Wood, and I'm not saying that the fund won't do well in the future, but let's be honest, the hype was a little extreme. But you know what the internet's like. Once the hype train starts rolling, it's hard to stop. So, after the amazing year, trading volumes reached new highs, rising from an average of around 5 million per day up to around 20 million per day. So, how is ARK doing now? Well, let me just remind you that VWRL, which can be used to approximate the global markets, is up 20% year to date. ARK, the revolutionary fund that has changed the investing landscape, minus 3%. But you don't hear about this now, do you? Literally, at the beginning of the year, everybody was talking about ARK. The amount of YouTube videos I saw talking about Cathie Wood being a genius and how this is the best ETF in the world, it made me sick. But now, I mean, I've honestly not heard about ARK in about 6 months. I was literally writing this video and I thought off the top of my head, I wonder how the ARK funds are doing because I've not heard about them for a while. And surprise, surprise, they're down 3%. Magic. Example number 2. Dogecoin. Now, you don't need me to tell you that this was absolutely everywhere. YouTube, social media, meme pages, Elon Musk's Twitter account, you name it. Somehow, people who knew nothing about investing, or even cryptocurrency for that matter, had caught wind of this memey crypto coin that is taking the world by storm. So how's it doing now? Well, let me remind you that it started the year with a trade price of around 1 pence, and it grew up to a value of 53p in May. No wonder it's got so much traction, because that is some crazy returns, you have to admit. But does that tell the whole story? Of course, not all investors bought in at the bottom and then sold at the top. In fact, the highest trading volumes were seen near the peak value. As the price went up, more people heard about it and wanted to buy in. So then the price went up, and then more people heard about it and wanted to buy in. It's just a positive feedback loop. So what's happened since May when we were up at 53p? Well, we're at 19 pence. That's a 64% loss. Now, of course, I'm not going to say that everybody bought in at the peak and got it wrong and have made huge losses. But at the same time, not everybody bought in at the right time and got out in time either. Nobody is shouting about Dogecoin now because the returns aren't going to the moon. Nobody cares. This is something that you need to understand as an index fund investor. When the Teslas, Bitcoins, Dogecoins or ARK funds go to the moon, you're going to hear all about it. But when the returns are suddenly crap, silence. But you need to be on high alert, because whenever those stocks or funds stop performing, there's already going to be the new thing. The hype train has already started again, and there's some other fund or crypto or stock that it's all following. There is always going to be another winner. It just comes around in cycles, whilst we sit on the sidelines with our steady growth. Yeah, it can be painful, I'm not going to lie. But in a way, it's peaceful. It's nice not having to worry about your returns, looking at the market every day, seeing how your stocks are doing. It's chill. For example, some of my mates who know I'm into investing make comments like, oh, the markets are doing well recently, are they? And I just reply like, are they? I honestly don't know. They instantly think that I just must not care that much. I mean, how could I, an investor in YouTube, and not know how the markets are doing? But because of my index fund strategy, I don't have to care. I'm literally not going to look at the markets. I'm just going to keep with my strategy and I'm going to invest the same every month. That's my plan. But anyway, I'm getting sidetracked. So what can we do about all of these winners out there doing our heads in? How can we learn to be a good loser? I'm not going to tell you to not listen to the winners, because it's impossible. They're online, they're at work, they're everywhere. Well, the first step is to simply accept that you are a loser. There, I said it, you're a loser. Wear it with pride. No, we're not losers in the sense that we finish dead last. We're losers in the sense that we will not be the best. Ever. Instead, we're more likely to see steady growth after years of investing, after years of discipline. It's not all going to suddenly pop off in 1 year and change our lives. We're not going to get rich quick. We're going to get rich by staying consistent. We're going to stick by the strategy and we're going to invest every single month, no matter what, earning our growth. Now, I fully understand that this is not going to appeal to everybody, and that's why low-cost index funds aren't for everybody. But for me, this slow, steady, reliable growth is a good thing. I'm investing because I want to achieve my financial goals so that I can live the life that I want to live. I don't want my retirement to be at risk, and I don't want it to depend on the performance of a few stocks or a certain cryptocurrency. By investing in low-cost index funds in a global portfolio, I'm spreading out my risk and I'm making my returns more reliable. I guess you could say that I'm accepting defeat. Kind of. Active funds, where active managers try and select a range of stocks in an attempt to try and beat a certain market index, are a great example to compare to. Let me remind you that these funds are run by the top dogs. Not Dave off Facebook who got rich off crypto, I'm talking about some of the highest rollers in Wall Street. These people dedicate their careers, and in some cases their lives, in an attempt to try and beat the market. So you'd think they'd be pretty good at it. Well, let's see exactly how well they do. Spiva track the performance of a variety of funds, both active and passive, and then compare them on a yearly basis to see how they've done. So if an active fund is trying to invest in US large cap stocks, Spiva would compare them to the S&P 500 for example, to see how they're doing against the benchmark. So first of all, we'll look at the US data. Over the past year, 60% of active funds failed to beat the index. I mean, it's a win for us passive investors, but admittedly, it's not that dramatic. But when you increase the timescale, the story really starts to develop. Over 3 years, 70% failed to beat the index. Then, over 5 years, it rises to 75%. That's a lot of people losing out to a low-cost, simple index. The story remains true all around the world. In some places, it's even more dramatic. No matter where you look, the active funds, on average, do not win. Again, these funds are run by the top dogs, doing everything that they can to try and beat the index. And so many of them are losing. I mean, come on, I don't want to be mean, but hundreds of people working together trying to beat a simple low-cost index is tragic. As the timescale increases, the odds are even more against them. Imagine that over an investing lifetime. What would you put your money on? The jazzy fund manager with years of experience and a great backstory, or the boring low-cost index fund that gets the job done. But there are two ways that you can look at this data. There's the glass half empty kind of way, and then the glass half full kind of way. You could say that you want to be the 25%-ish that do successfully beat the market, and that you're willing to fight against the odds. There is no guarantee that you're going to win, and remember, if you fail, your retirement or future investing goals are on the line. Or you could just chill out, like me. Accept defeat. Accept that we will not be the best investors in the world. And that's fine. Be happy to listen to the noise about all of the winners on the stock market, and be happy for them. But make sure to keep your eyes on the prize. For me, I just remember why I'm investing, and it makes defeat that much easier to swallow every single day when I scroll through social media and when I'm watching YouTube videos. I recommend that you do the same. Stay classy, everybody.